What's going on, everybody? It's Quinn Black, and this video is going to be called Confluence 2.5, which has been probably the most anticipated video based off of like my training site for a while, actually. Um, Pretty much, Confluence is my trading style, which is Confluence trading, which is overall trading with based off of multiple confirmations within a market when things line up. That's giving you like overall powerful ass reason as to why you're entering the market at a certain time, which is very, very important. And it takes me a while to actually make all these videos because it actually takes time for me to actually gain knowledge and actually apply it. So these past few weeks, these few months, I've been gaining like more and more knowledge as I go, as far as little things just kind of help out my technicals, my overall candlestick analysis, and my overall clarity of the market itself. All right. So at the end of the day, like I always try to like gain more knowledge to overall benefit you guys, So because the more I learn, the more you guys learn. So I'm gonna always be a student and always try to actually apply more as I do go. But overall, have keep a clean chart. Like it's not like I'm actually gaining more knowledge and just like applying more to my charts as far as indicator wise and stuff like that, because at the end of the day, it's all about learning the foundation of the entire market. Once you learn the foundation, then you can overall read the market itself for what it is. If not, then you're going to have a little bit of confusion and everything when it comes to the market. For after it makes a certain move, like if you don't know how to actually analyze it correctly, then you're going to get thrown off completely. Okay, with some people, like my students, they're pretty much ready for whatever the market throws to them. You know what I'm saying? Because they're overall like realizing that the market does have to move, and it's not going to always move in your favor right when you think it is. Like that's where the patience thing kick in. And the main important thing is if you can catch a move in the market, that's as good. That's like the main thing that you have to actually like work on, because like anybody can scalp. Anybody can catch like 1 pip or 2 pips, but can you catch 10, 20, 30, 40, 50, 60 pips, 80 pips, 100 pips plus more? Can you do that? That's catching the entire move. When you're able to catch the entire move, that shows you that your analysis is correct. That's why like whenever some people like dumb and ignorant, like the sophomores, the sophomores or the freshmen probably that are in this trading industry right here, like they're new, so they don't really even know too much better, too much. They overthink the entire move, right? Like for example, some people will be like, "Oh, yeah, man, it hit a level of resistance right here. It came up. It's gonna drop 200 pips like this." Like, I was like, "Yo, you can't even get past 10 pips, much less 20 pips. Like, why do you think it's gonna get all the way down there when you can't even get past the first couple increments and everything of that whole entire move?" Like that overthinking thing, like, is very, very annoying, and you need to really stop doing that, because you have to get past your first few pips and everything, or your first few moves, or your first few flows of the overall move before you actually get the gist of what the market is trying to show you overall. Okay? Never overthink the market. Never try to like figure out the future of the market. You know what I'm saying? Like as the market is flowing, just flow on with it. You know what I'm saying? Like don't try to like go against it, argue with it, that kind of shit. You know what I'm saying? Like everybody's gonna have their own analysis at the end of the day, and the best analysis that you can trust is gonna be yours. So just keep that in mind also. And pretty much like what I'm the main thing I'm explaining on Confluence 2.5 is gonna be based off of like my move that I caught on USD what was it, like almost a week and a half ago? Almost a week and a half ago, I think. Almost a week and a half ago. Or was it last week? I think it was last week. Yeah, California. It was last week. And overall, like, I caught probably 200, 300 plus pips on that whole entire move, like, that was in this uptrend that entire freaking week. And a lot of it is just based off of, like, what I learned recently and how I actually applied it to my charts to actually benefit me. Like recently, I've been also using Fibonacci expansion levels to help me with my projections. Because some people always try to like they kind of like lost onto where they should actually get out of the market. And with Fibonacci expansions, it can help you actually get that projection for what you're actually looking for. And that helped me on this entire move and everything that I caught, also just based off of some projections that I had in mind for this entire pair. And expansions overall are just the kind of like the cousin, or it's within the Fibonacci family. This right here is Fibonacci retracements. This right here is Fibonacci expansion, which is overall a 3-step process. I'm sure you guys how to draw that later on. And many might see also that I don't really, my charts aren't too cluttered. Like the more I learn, the less I'm putting on my charts as it is. But I do also try to like identify my main levels of support, my main levels of resistance overall. And a few things that I did also on USJPY was always try to like just find out where that strongest level of support is, where that strongest level of resistance based off the highest time frame first. And when I say the highest time frame, I mean the monthly time frame, which is the highest one in our eyes. You could also analyze off any time frame, but keep in mind that not all time frames are going to be as smooth as the other one. The higher time frames that you do go, the more condensed or more compact these candles are getting. So when it's more compact, that's giving you more clarity on what market's trying to show you, right? So at the end of the day, like whenever you see a cluttered chart, like let's say if I'm on a 1 hour time frame, if it looks too noisy for you as far as too much going on, too many unnecessary wicks, that kind of stuff, go on 1 time frame higher. And when I say 1 time frame higher, I mean 1 time frame based off of the actual standard time frame structure, which is basically the 1 minute, the 5 minute, the 15 minute, 30 minute, the 1 hour, 4 hour, the daily, the weekly, the monthly. That's standard. So whenever I actually have too much noise on the 1 hour time frame, go on 1 time frame up, which is going to be the 4 hour time frame, which is that 1 time frame higher than based off the standard structure of time frames. If the 4 hour chart looks too noisy, 1 time frame higher. That's going to be what? The daily time frame. Bomb. You see a lot more structure as to what the market's trying to show you. Okay? If the person was looking at here, they could have found a median area within this entire zone, as far as a median area where the market was finding a level of support. A lot of this also is based off of like my trading style. If you guys are my students, as far as Wall Street Academy, like straight focus on Wall Street Academy students, like you know this shit like down back by this time at least. For the outside classes, which is the overall group, which is Forever and Profit, some students and everything, they might focus on other training, but students that are focused on my course, they would have caught this move right here. A lot of them did catch like a good amount of this move, and a few of my friends also were actually trading with me that was based off of my trading style as well. So they knew exactly why I was getting in the market at a certain time, just based off of like what I'm actually looking at and like what I'm looking for based off of Confluence trading itself. Okay, so at the end of the day, like you gotta always realize that there's always gonna be certain areas that you could draw certain things. Okay, I'm not gonna always draw a support resistance on every single time frame if I don't have opportunity to draw it. I'm not gonna always have opportunity to draw a trend line. I'm not gonna always have opportunity to draw so many things. You know what I'm saying? But overall, you have to realize that you have to try to like you got to try to draw them in some kind of way just to see like if you have an opportunity to draw a certain thing at that certain time within the market. So on the monthly time frame, a lot of people realize that like this right here was overall trend line that was descending based off of like the top areas within the market itself, right? It was right here. One area was right. My bad. So you have your point A and point B right here, which is based off your trend line. Once you have your point A and point B inside the market, then you can actually draw your trend line. If you don't have a point A and point B, then you have no kind of opportunity to draw it. And point A and point B can also be on a downtrend. Point A and point B is based off of a high to a lower high. An uptrend is based off of a low to a higher low. So at the end of the day, it's kind of like it acts as a level of support on an uptrend, acts as a level of resistance on a downtrend. So it kind of helps you guide on where the market is actually trying to actually come back down to make a lower high or to make a higher low. It all kind of depends on the overall trend that you're actually in. So when it came down to this right here, this setup, once I seen actually breaking this trend line right here, it came from a sell zone, which was when the market was actually under a trend line, it's a sell zone. So that's when you're actually looking for the market to actually bounce off of the trend line, creating lower highs the entire time. On the opposite end, you're looking at a buy zone. Okay. So the major thing that I did on this was also always try to confirm your major level of support resistance. I already found my level of support based off of the monthly time frame. Probably alter a little bit right here. And it's based right here only because there's two areas within this intersection level that acts as a level of support and a level of resistance overall. So if I look right here, this spike, it bounced off when it actually hit that level, which means that that is considered as a level of resistance. On the opposite end, it's looked like it bounced off, which is considered as a level of support. Same concept when it actually happened right here also between these two. I'm gonna color for you guys. A level of resistance and a level of support. So overall, that is probably like my main area for this entire setup right here, for a level of support and a level of resistance. And when it comes to drawing key levels, I always try to make sure that they're less than 10,000 pips, which this right here is still valid because it's still under 10,000 points, which is 1,000 pips. So once it's under 1,000 pips, which is 10,000 points, which means that you'll see 100 as far as like a five-figure number right here. Once it hit 5 figures, then it's invalid because it has to be right under 10,000 points, which is considered as 1,000 pips. Okay, so once I identified those, I knew that I was pretty much set up good for these key levels, which is this one right here will be my monthly right here, show text right, show text right there. Next thing I'm trying to do is pretty much get my weekly, which is considered as the 50% area of these monthly key levels, which I could draw right here, that 50% line, which is that red line right here, and type weekly on there. Show on text left. Okay, so that's like my 50% mark, which as you can see, it acted as a level of resistance right here perfectly, just based off of like using my Fibonacci and actually having that level of support and resistance based off the monthly time frame, which is like my monthly key levels. So within this entire zone is what I'm working towards on the lower time frames. So me seeing that it's respecting a strong level of support, that means that it found an intersection level, which gives me some kind of clarity of what the market is trying to show me on certain cases. Okay, so all that was just based off of me getting my foundation overall. But as you can see on the monthly time frame, that whole area was still supported. That's why there's a lot of wick areas around that area. Just based off of me actually putting those median between those two spike areas, that gave me my median area, which actually you can see those are wick points, all wick points, and that shows me a strong level of support itself. On the daily time frame, you can see that trend line a bit more clear, which it guides you as to where it was going overall. And if you look right here, the market actually found a level of support right here also for the current market price. But when I was actually executing this entire setup right here, the first thing I always look at is structure. If you're not looking at structure when you actually get on the charts, then you're missing out on the major areas of what the market is trying to actually move. People that actually know structure, they don't really get faked out because they know the overall trend of the market on what the market is trying to show them, and not really falling for all the unnecessary wicks or unnecessary spikes, that kind of shit, because they know the overall trend, and they know how and a broken trend looks overall also. So I mean, like once you actually have knowledge of that, then you're pretty much good for the future of what the market is actually trying to develop. Because at the end of the day, like market is all about just anticipation. Like once your anticipation is there, then you could attack the market in any kind of direction as far as start finessing the market and then actually benefit from it every single fucking day. And with structure, it's all about just locating your lower lows and lower highs based off the overall trend, the current trend, that kind of stuff. So when I drew this overall trend, which is this trend line right here, that was giving me my overall trend for that bigger time frame. And once I realized that I know the overall trend for that bigger time frame, that's helping me. That's helping me just get over the fact that I won't be confused as to what kind of trend that I'm in and the overall move of that entire trend. So like while I'm looking at this trend line right here, I'm looking for lower highs. So this right here was a lower high. Lower highs. Lower highs. Lower highs. Okay, and on the inside, it's also a lower high right here, a lower high right here, right back on that level of support. Okay. The main thing I actually did throughout this whole entire process was actually I was on the lower time frames. I was on lower time frames a lot of this time right here, and me realizing that the overall trend was a downtrend within those areas, that means that a level of resistance was right here to some extent. I'm always trying to find the median area between those wicks. When I'm finding a random ass area, I always put it on my blue line, which is my random line. That gives me my newfound support. So whenever the market actually breaks a previous lower high, that means that what? The market broke structure. When the market breaks structure, what does that mean also? That means that you're overall changing your trend. And when you're changing your trend, that means that the market is transitioning from a downtrend to an uptrend. And that's very, very important. Right before you actually put in your orders, you have to know the overall trend, because you don't want to get inside the market and not know like what kind of market am I in? Buyer's market, seller's market, what am I looking at? Okay? And when you're actually looking at trend and structure, you have to always make sure that it's actually in your favor based off the current direction that's actually flowing in. And later on also I'm talking about invalid patterns and valid patterns based off the current trend that you're actually in. Based off of like what patterns are going to be valid in an uptrend, what patterns are going to be invalid in an uptrend, what patterns are going to be valid in a downtrend, what patterns are going to be invalid in a downtrend. It all depends. And that's all based off structure also. So at the end of the day, like me seeing that the market actually just broke this previous lower high, ASAP, I pull out my fibs. Why? Because once the market finds a level of resistance somewhere up here, and that resistance area can also be based off of previous areas within the market. Okay? So if I go on my line chart, right? Since I'm on an H4 chart, I'm on my line chart, what color do I put it? Green. Make sure that there's no kind of writing on it. And what I'm looking for is the overall area within the market where I actually find the shit ton of spikes, which was located like right here. Areas like right here, like they're all over the place. So one area right there, another area up here. Those were both considered as H4 support resistance, all based off of these two spikes right here. See how the market actually found support right here. Yellow. And directly on the area when the market found a level of resistance right there. So overall, it acted on both sides, which is very, very important. The same way how it acted on right here. It acted as a level of support right here. It acted as a level of resistance right here. So that tells me that market overall have an indecision level based off of that price, which means that every time the market touches that certain price, it acts very, very crazy, which means that the market kind of slows down, try to figure out like, where do I want to go now? You know what I'm saying? Like, is buyers going to come in? Is sellers going to come in? Like, what's going to happen? So it tries to reject a portion amount of time and then go back down to a level of support where it actually found a major, Damn, why is this here? My bad. Take this off. It tried to find that next major level of support where the market was not trying to actually pass through. So if I'm looking at this area right here, where I actually started analyzing earlier, the first thing I'm doing is pretty much getting my fibs, point A to point B, which is the top point to low point, which is a low to a high on an uptrend, a high to a low on a downtrend. So like in this area, I'm measuring from the lowest point to the highest point. Okay, and it's all based off move. This right here is a push. This right here is a pullback. This right here is a push. This is a pullback. This right here is a push. This right here is a pullback. This right here is a push, pullback, push, pullback, push. You know, right now the market's on a little bit of pullback right now also. So some people always try to ask me like, why can't I put it here? You know, like, remember, it's all about preference. Like both ways would have still been valid at the end of the day also. But me, like, I like to just keep it at the previous lowest point, at the major or lowest point to the major highest point, which is right here, based off of structure. And when I mean that, I mean this is how a structure looks. You have an uptrend, downtrend. I mean uptrend, countertrend, uptrend, countertrend, uptrend, countertrend. So all these countertrends, all these little moves for when the market was backing off and trying to bring sellers in the market, it only tries to bring sellers in to make the overall market balance. If you're in a buyer's market for 10, 12, 13 days, it's going to have countertrends. And because sellers are going to try to come into the market and try to actually make their currency a bit stronger. So this whole entire time, the USD was getting stronger because the USD is the first pair, which is the USD JPY. The main pair, which is USD, is going to always take value as the market is going up. When the market is going down, that's increasing the value of the JPY pair, which is a secondary pair, which is decreasing the value of the USD. So this main chart overall as one is for USD. But on the opposite end, JPY benefits off of it as the market is actually going down. You know, so like it's always two sides of the story. That's why you're able to make profit off both sides, to buy and to sell when you're actually trading Forex. Give me 1 second. Okay, so the main thing that I seen within the whole entire thing is that the market fully tapped 61.8 overall. It was sitting structure at 50%. 50% is not considered as a level of a PRZ level for me, but I mean it's on your Fibonacci, so it's still considered valid, and you could use it for expansion levels also. So whoever wants to write this down, real quick, take out some pens and pencils. Pretty much, like, I have like my notebook. I tell everybody every single day that notes are very important to trading. You know, like, despite how long I've been trading, you know, like, I still take notes. You know, like, because personally, I do want to fill up this freaking book right here and just make this book be valuable as shit, honestly. So I mean, like, that's my goal. But overall, like, I never really stop taking notes. Notes are very important. Always have your Fibonacci books. I mean, your FIP books. Keep in mind, like, I have multiple books. Like, there's multiple books. You know, there's all over the place. Every single thing having to do with forever and profit is gonna have a bull on it. They're everywhere. Like, they're everywhere. So I mean, at the end of the day, like, this right is very valuable. So with Fibonacci expansions, okay. With Fibonacci expansions, everybody knows that there's always a point A and a point B when you're using your fibs itself, based off of like what I taught you guys inside the previous videos. So point A is going to be your lowest point if you're on an uptrend. Point B is going to be your highest point if you're on a, point B is going to be on a higher high if you're on an uptrend and at a higher low or a low on an uptrend. All right. Point A is going to be a low or a higher low on an uptrend. Your point B is going to be a higher high on an uptrend to measure the countertrend. Got it? So what you're measuring on fibs overall is you're measuring countertrends. That's what all fibs are. Like, fibs, all you're measuring is countertrends based off the current trend. If I'm on a downtrend, I'm only measuring when the market actually goes against that downtrend. You know, like, that's what you're measuring, and that's what the PRZ levels are for, called price reversal zones. So the market itself has to stay under 100% if it wants to stay in between structure, okay? So if you're in the market, right, the market it could drop me draw a little example real quick. If we're in an uptrend, right? The market can retrace all the way down here. As long as it doesn't break this previous level of support, then it hasn't broken structure, which means that it still has it's still valid to go on the uptrend. Okay? At times the retrace can be very, very small, like this, and then go up. At times it can be large, like this. Actually, my bad. That's broken. It can be up like this, go small like this, and then bounce off like that. But once it breaks a previous lower high and goes against it, that's when it broke structure, which means that you're looking for lower highs and lower lows beyond that, starting the downtrend. But everything has to be valid. So even though it broke like right here first, it wouldn't be valid up until the market actually comes back up. You put on your fibs from a high point to a low point, and you're measuring this counter trend based off of like where actually it found next. So based off of the new lower high that it created once it broke structure, that gives you validation for that downtrend. So you're looking for the market to actually come back up to retrace up to a PRZ level and then continue based off of like where it was going, just off of you knowing that it broke structure. Okay. Let me erase all this real quick. All right, so pretty much like what I seen with JPY, it was just based off of all the examples that I'm gonna give you guys like right now. So with fibs overall, you have to know your PRZ levels. 23.6 is not really considered as a PRZ level, but I've seen that the market actually, it doesn't get enough sellers if it's in an uptrend to actually take off. So it goes to that first retracement, which is going to be 23.6. At times, it doesn't have enough of the opposite market to actually go all the way down to 38.2, which is happens, you know. But if it does have enough, for example, like if I'm on an uptrend and it creates enough sellers, it'll go to 38.2. You know what I'm saying? But if it doesn't, more likely it's gonna retrace very, very slightly and then keep on pushing up because there's too many buyers in that market or there's too much momentum flowing in that certain direction, which can show you a lot about like the overall like the trend itself. And the way how I actually capitalize off of this was just knowing projections also. So when it comes to Fibonacci expansions are going to be right here. It's a 3-step process. The way how you draw them is you put it from your point A on your fibs, which is going to be at your 100% line on an uptrend, all the way up to your 0%, which is your point B on an uptrend, and then down to where the market found a level of support based off of fibs. Right here, it respected what? It respected why is the person calling? It respected 50%, which means that off of expansion levels, that's going to be considered as a 200% expansion, which is all the way up here, that was the area for your target, which is going to be a yellow line right here. I wish I had my old markup. I probably can see it. I had this area like marked off literally so long ago. Like this right here was my first target, which is this yellow line. These were all targets and everything just based off of like me analyzing. This is like my overall, as you can see, I do a lot of technicals. You know, I do a lot of technicals. Hold on, give me 1 second. I do a lot of technical, so it's a lot of knowing how structure works, knowing how your trend line works, knowing how what's valid, what's invalid. It's a lot of freaking work. And to new people, this might look crazy as hell, but once you actually learn like what you're doing and what you're looking at, then it's gonna be solid. So me seeing that the first retracement, mind you, this right here is all based off the first retracement. So like once I see the market break that level of resistance, which was a previous lower high, that shows me that the market just broke structure. So like overall structure was broken right here. Let me get my arrow. Structure was broken based off of, well, this candle right here. Okay. Broken structure. Remember, you have tested candles and broken candles. If you're looking at a tested candle, the market literally hits a level of resistance or closes on a level of resistance, and the candle after it takes that opposite direction, which means that it's respecting that area. When a candle is broken, it forms on a level of resistance, and that next candle after it keeps on going within that same direction. That shows you that validation that the market actually broke structure, and that it actually is pushing and is broken that level of resistance. So me seeing that it broke a previous lower high, structure was broken. So what am I looking for now? I'm looking for the market to actually find a level of resistance, which I could draw my fibs on, which was my point A and point B, point A, point B right here, and I'm measuring the counter trend. Remember, in the uptrend, all you're doing is measuring counter trends with your fibs. So the market itself came all the way down to 61.8, which was a PRZ level, which means that the lowest point was 61.8, but the market found structure at 50%, which was considered as my higher low point, which was right here. That was considered as a higher low. So this whole time that this is where my foundation of the market that I'm going to be based off of as far as like my projection and so on. It's all based off that first move once structure is broken. Okay, so once I realized that, I had the projection all the way up there, but as far, like at the end of the day, like I have to get through all this to get to 200%. So it's all about maintaining your order. In trading, the hardest thing is to maintain your order throughout the entire time, because you're watching the counter trends, you're monitoring the counter trends, you're analyzing this, you're analyzing that. It's so much going on up until it actually gets to your projection, which is far as hell. So with Fibonacci expansions, if the market retraces at 38.2, you're looking for the projection based off expansions to be 224% through 261%, 261.8%. If the market found structure at 50%, your projection is 200%. If the market finds structure at 61.8%, your projection is what? 161.8%. Okay? If the market finds structure at 70.70%, the projection is 141.4%. If the market finds structure at 78.6%, the projection is 127%. If the market finds structure at 88.6%, that means the projection is 113%. So at the end of the day, you have to pay attention to like where the market actually finds its spikes, where it actually finds support. Everything is valid. Okay. So beyond that, I always have, once I have my point A and point B off anything, I could always like actually help predict the future of the market as far as the projection of the entire market. I always try to like see if I can find a level of a trend line within this whole entire zone. I think I found a trend line somewhere over here. Everything is in a moment, so where did I draw that trend line? Yeah, I think it was right. I can't remember if it was there or not. Because trend lines are very, very subjective. You have to like literally draw them on certain time frames, and if you draw them on the incorrect time frame or incorrect wick to wick, then it's gonna get thrown off completely. But I think I drew here. I'm not even sure honestly. But overall, if I did draw there, I was looking for the market to actually make higher lows on those entire areas. But as the market was flowing up, as I was actually trading the market like every single day, I'm only looking for certain patterns and certain trends to make it valid, so I can actually capitalize off of it when it's actually flowing in my favor. And these patterns were like this. Let me find a few. I'm trying to find when I was on the trend. I was flowing on the trend. Okay. Okay, the main thing that I look for in an uptrend, and it's just remember, like in time, I'm just learning more. I don't know everything, but what I do know, makes me money. So F it, you know. But in an uptrend, right? Only valid patterns that I look for are gonna be bullish engulfing patterns and bullish engulfings overall. Even when it comes to like, let's say if I see things that look like this, like doji type, like morning stars and everything. If the market plays a doji, I don't really count this. I exit out, exit out, X out, and I just put those two patterns that was on the left side and right side together. That gives me my pattern. Okay, whatever. That gives me my pattern for what I'm looking for. So in the uptrends, I'm only looking for bullish engulfing patterns, which was right here, right here. And so those are my entry areas for when I'm in the market. And these areas are going to be located on higher lows only. So when I'm seeing a bearish engulfing pattern in the uptrend, that's considered as invalid in my opinion. And I wouldn't really take those because that's all a counter trend. That's all short-term stuff. So the only thing I'm really looking for is going to be bullish engulfings. In a downtrend, I'm only looking for bearish engulfing because they're going to be located on lower high points. So in a downtrend, the bearish engulfing patterns that I'm looking for is going to be located on lower highs, which means that you have to put on your fibs. Once the market find a level of resistance at a PRSV level, I'm looking for the market to actually create a candle reverse pattern around that range and go within my favor. But it has to make a bearish engulfing pattern. A bearish engulfing just says that sellers are in control and the buyers are slowing down. Okay, so it could be in a counter trend the entire time, but within that whole counter trend, the market is not creating bearish engulfing patterns. You know what I'm saying? It's not going to create it. So if you look like right here, for example, this right here was an uptrend, right? The whole entire time, the market is not creating any kind of bearish engulfing patterns. The entire time, up until right here. Wow. Sellers are in control. You could have gotten right here, seen a little bit of drawdown, but also what happened right here also. Bam. Lower high. But also that is a bearish engulfing. So that shows you that sellers are already. Either way it goes, depending on what kind of trader that you are, if you know the overall trend or the short-term trend, you could have gotten based off of that pattern right there. Once again, bearish engulfing. Bam. Seller are in control. Entry right there. Bam. Entry right here. Bearish engulfing pattern. Bam. Close. You know what I'm saying? Throw it in, let it ride out, then go from there. And that's off of you knowing the overall trend. So if you don't know the overall trend, you can't even execute these orders on low time frames. You have to know the overall trend so you're aware of if you're in a counter trend or if you're in the current trend. If you're in the counter trend, you're not going to keep that trading for too long because it's short term. It's not flowing with the overall trend. So what I was looking for the entire time that the market was flowing in my favor was I'm looking for higher low points, and I'm looking for bullish engulfing patterns on low time frames. And me knowing structure on how structure plays out, the market couldn't have broke a previous higher low, and then me seeing that it never ever broke a higher low point, so it was still on the overall trend. So every single time that market retraced, I was literally getting in based off of those bullish engulfings, based off of those counter trends. And it's sweet. It's sweet because it's giving you that capability of upping your lot size a bit more to just capitalize it off a bit more also. But overall, you're analyzing the entire time that market is flowing. And as you're doing that, you're not really catching any kind of like fake outs or stuff like that because you know the overall trend itself. If it's overall in an uptrend, I'm looking for only bullish moves. And as you can see on the monthly time frame, it had a big ass bullish candle. On the daily time frame, it had a big ass bullish candle. So why would I try to go against it? It doesn't make sense though. And on the monthly time frame, it's a big ass bullish candle. So if it's bullish on the monthly time frame, why am I really looking for sells too much? Plus, me seeing that the month is what? It's Saturday the 15th, which means If 15 days go by and this still stays above this candle right here, the market's going bullish. It's going in a bullish trend. You know, because that's a bullish going pattern on it was on a downtrend, which found a level of support, which showed you that this market was still staying consistent this entire time. 1, 2, 3, 4, 5 months of level of support. It might be time to take off, you know, and this is the waiting game right here. So, I mean, at the end of the day, guys, it's all about patience. It's all about patience. So, I mean, that is what kind of guided me for this entire method right here. And as the market just kept on going up, I kept on analyzing. As when it actually found a level of support, a level of resistance, that gave me my areas to do what I do also. Once again, 88.6, which is the PRZ level, 78.6, which is the PRZ level. What am I looking for? Right here. What is this? A bullish engulfing pattern, which shows you that when this market was going down, right? Remember, always look at it kind of like a business. On this counter trend, you would never see a bullish engulfing pattern. Why? Because buyers are not in control in a counter trend. That doesn't make sense. Sellers have to come in control to a certain extent. As long as it's not breaking this low right here, I'm still good. You know what I'm saying? Because the PRC levels are going to hold me up if I'm in on a certain kind of trend. So when the market actually slowed down, consolidated right here, once it found that buyers are in control and it's over and it's bigger than a bearish engulfing pattern, entry is literally right here. That's your entry point. Bomb, and you take it up. You know what I'm saying? Like every single time. So every single move that happens, you're actually taking advantage of it just based off of you knowing structure and how structure forms. And you seeing that. Let's see if we can get an expansion level for this also. So if the market retraced at what, 88.6 or 78.6, the projection for that based off of your retracement is going to be 127 off 78.6 and 113 based off of 88.6. So your point A, your point B, and your point C is going to be where the market found a level of support or found structure, which is going to be probably right here. So, what was it? 27%. So if I put it right here, then probably found structure at this. Yeah, it found structure at 88.6%. And what did I say about 88.6%? 88.6% is giving you a 113% projection, which is going to be right here based off of expansions. Okay? If it was one thing up, as far as if the market found a level of support on 70.6, then it would have been at 127. But since the structure stayed between these areas, 78.6, that 113 is your projection area, which is literally a shit ton of pips, which was probably, let's say, from here to here, 168 pips, which is a shit ton of pips, which is $1,682 on a standard lot, which is crazy. But it's all about just overall like knowing how to analyze the market from all kind of angles, and it can benefit you dramatically, you know. But always be ready to take action on the market. Don't chase the market, just flow with the market. Don't chase the market, just react to what the market shows you and then go from there. But hope you guys enjoyed the video and be forever in profit. And if you guys are on Wall Street Academy, trust me, like one of the best decisions and everything that I ever done was actually to open up the focus group, which is Wall Street Academy, which is also a subgroup of Forever in Profit. So the difference between Forever in Profit and Wall Street Academy, people always get this confused, is that Forever in Profit is the overall brand. As you can see, nothing says Wall Street Academy. Nothing says Wall Street Academy. Wall Street Academy is just a subgroup of the main group. So I promote the main group, which is my group, and everything under it is representing the overall brand, which is still Forever in Profit. You know, like subgroups can form under it all day, but I'm the only subgroup under it. So at the end of the day, like guys, if you guys do want to get on Wall Street Academy, which is the focus group, which has all my material, all my mentorship material, extra, all the webinars that I've ever recorded, all that stuff is going to be on Wall Street Academy. You know what I'm saying? So hope you guys enjoyed Confluence 2.5. This is probably like the fucking longest video that I've ever done. It was like kind of like a webinar. But hope you guys enjoyed it. Hope you guys gained knowledge from it. And yeah, make sure you guys follow me also on Instagram, Cuebanks, on Facebook, facebook.com/MCAQ. And yeah, peace out, guys.